Hello everyone, I am Dr. Soundararaj. I am very happy to interact with you all through this video. In this video, I am going to teach you the calculation of payback period, accounting rate of return, net present value, profitability index and IRR of a capital investment project. These are all a couple of details related to my career. After you watch the full video, if you find the video beneficial to you, give a like to the video. Kindly subscribe my YouTube channel and enable the notification so that you will get the notifications of my new videos on commerce and management topics. Let's get into the problem. X Limited is considering investing in a project requiring a capital outlay of 8 lakh rupees. Forecast for annual net incomes after depreciation but before tax are as follows. So we are given with the annual net income after depreciation but before tax for the entire life of the project. The life of the project is 5 years. So we are given with the profits after depreciation but before tax for all these 5 years. Depreciation may be taken as 20% on original cost and taxation at 50% of net income. You are required to evaluate the project according to each of the following methods. A. Payback period method. B. Rate of return on original investment method. C. Rate of return on average investment method. D. NPV method, taking cost of capital as 10% per annum. Profitability index method. And the last one is internal rate of return method. Let's get into the calculations. Statement showing cumulative cash inflow which is required for calculating payback period of the project. Now the data that are presented in the problem are given in the first two columns. The next one is about profit after tax. From profit before tax, let us calculate 50% of tax. And the remaining of profit before tax is nothing but profit after tax. For example, the first year profit before tax of the project is 4 lakhs. If you deduct 50% of 4 lakhs which comes to 2 lakhs, the balance 2 lakhs is named as profit after tax. Similarly, for second year, 4 lakh minus 50% of the same, it gives us 2 lakh rupees. That's profit after tax for second year. For third year, 3,20,000 minus 50% of the same, it gives us a balance of 1,60,000. Then for the fourth year, also the same calculation. When it comes to fifth year, the profit before tax is 1,60,000. You deduct 50% of the same so that you get the balance of 80,000 as profit after tax. Now, since we want cash inflow to compute payback period of the project, along with the profit after tax, we need to add the depreciation, which is a non-cash expenditure, which was originally deducted to calculate this profit before tax. We add it back with the simple reason that it is non-cash expenditure which doesn't affect the cash inflow of the business through the project. That's the simple reason why we are going to add depreciation with the profit after tax to get the cash inflow. Now for first year 2 lakh rupees plus 1,60,000, it gives us 3,60,000 cash inflow. Second year 2 lakhs plus 1,60,000, it gives us 3,60,000 of cash inflow. Third year, the similar calculation is done. We get 3,20,000. For fourth year, if you do the same calculation, you get 3,20,000. For fifth year, we get the cash inflow of the project as 2,50,000. Since the cash inflows are not uniform for these 5 years, we will go for calculating cumulative cash inflow with the help of which we can find out the payback period. If the cash inflows are uniform, we can apply the formula of original investment divided by annual average cash inflow will straight away give us the payback period. Since the cash inflows are not uniform, we go for the cumulative cash inflow method for calculating payback period. That's a simple understanding. Now first year 3,60,000. Till second year, if you add these two, you get 7,20,000. Till third year, it comes to 10,40,000. 10,40,000, it crosses the original investment of the project, which is nothing but 8 lakhs. Therefore, the payback period should lie in between the second and third year. Perhaps till second year, we could recover 7,20,000 rupees of our investment. For the balance of 80,000 rupees, to get back our full investment of 8 lakhs, we depend upon the cash inflow of the third year, which is nothing but 3,20,000. That is why I very clearly said the payback period of this project should lie in between second and third years. Now let's look at the calculation of payback period. Payback period 2 years plus investment minus cumulative cash inflow till year 2 divided by cumulative cash inflow till year 3 minus cumulative cash inflow till year 2. You need not follow this denominator. Perhaps you can straight away write the cash inflow of the third year as the denominator. Still you will get the answer, because finally this calculation will give you the cash inflow of the third year as denominator. You can see it here in this step. Now let's look at it. 2 years plus 8 lakh investment minus 7 lakh 20,000 cumulative cash inflow till year 2 divided by cumulative cash inflow till year 3 minus cumulative cash inflow till year 2. If you find this method is very convenient for you, you can go for it. Fine. The next step is what? 2 years plus 80,000 divided by 3,20,000. This 80,000 is the balance investment to be recovered from the third year cash inflow of 3,20,000. That is what the idea. So it gives us 2 plus 0.25 and finally 2.25 years. If you want the result in years and months, you can go for another calculation. What is that? 2 years plus 80,000 divided by 3,20,000 into 12 if you put, you get the answer of 2 years and 3 months as payback period for the project. Now what is the analysis they have made? Since the investment made in the project is recovered during the project period itself, the project may be undertaken. See, any project which gives us back the investment within its lifetime, it is an acceptable project according to payback period. Here the life of the project is 5 years, but we are able to recover back our investment within 2 years and 3 months. Therefore, obviously this project is an acceptable project as per the criterion of payback period method. The next one is what? Computation of rate of return on original investment. Counting rate of return is the only method for which we depend upon profit after tax as an input. For other methods of capital budgeting, we will be using cash inflow of the projects. What is the meaning of cash inflow? Profit after taxation but before depreciation. Fine. Let's come to this calculation of return on original investment. Average profit after depreciation and tax divided by original investment into 100. Average profit after tax is calculated as what? You sum up all these values, the profit after tax for the 5 years. 2 lakh plus 2 lakh, 4 lakh, 4 lakh plus 1 lakh 60,000, 5 lakh 60,000, 5 lakh 60,000 plus 1 lakh 60,000. It comes to 7 lakh 20,000, 7 lakh 20,000 plus 80,000, it gives us 8 lakh rupees. That is what they have done here. So 8 lakh rupees is a total profit of the project for all the 5 years. I mean the profit after tax divided by 5 years, it gives us the annual average profit after tax of 1,60,000. Now let's calculate return on original investment. The annual average profit of 1,60,000 divided by original investment 8 lakhs into 100, it gives us 20% return on investment. What is the analysis? If the return on original investment is higher than a comparable return rate which is fixed by the company, the project may be accepted. Computation of rate of return on average investment. The formula is what? Average profit after tax divided by average investment into 100. The average profit after tax 1,60,000 has been already calculated. Let us now calculate the average investment. What is the formula in this situation for calculating average investment? Investment divided by 2. It gives us 4 lakh rupees. So accounting rate on average investment is 1,60,000 divided by 4 lakhs into 100. It gives us 40%. The analysis is what? If ARR is higher than a comparable return rate, then the project may be accepted. Now let us calculate the net present value of the project. For calculating net present value, we should make use of cash inflows from the project for its lifetime that are presented here. Now discount factor at 10% that we have picked up from PVIF table for 10% and that are written in this column. You multiply the cash inflows with the respective PVIF factor for the years, you get these discounted or present values of cash inflows for all these 5 years. The total of the present values of cash inflows for 5 years comes to 12,32,520, from which you subtract the cost of the project 8 lakh, you get the balance 4,32,520 as a net present value. Since the net present value of the project is positive, this project is accepted. Now, computation of profitability index. What's the formula? Present value of cash inflows divided by present value of cash outflow. 12,32,520 is the total present value of cash inflows divided by total present value of cash outflows of the project, which is nothing but investment of the project, 8 lakh rupees, is equal to 1.54. If the profitability index of a project is more than 1, obviously the project could be accepted. Then the next one is about computation of internal rate of return. Internal rate of return is a rate at which the present value of cash inflows of a capital investment project is equal to the present values of cash outflows of the project. Here, since the present value of cash inflows is more than the cash outflows 8 lakh rupees, a much higher rate should be applied. As you all know, if you have watched my previous videos and especially the video on calculation of IRR, IRR is normally calculated using trial and error method, and we are going to make an attempt with another rate. We have already calculated the present value of cash inflows of the project at 10% for computing NPV. We can use the same. Now, since the present value of cash inflows of the project at 10% is much higher than the investment of the project 8 lakhs, we should try a higher discount factor. Then only we will get lesser present value of cash inflows. I mean, we will get the present value of cash inflows which would be lesser than 8 lakhs, because we want to get one total present value of cash inflow which is higher than 8 lakhs and another value which is lesser than 8 lakhs, so that we can make use of the statistical technique named interpolation. Interpolation will help us to identify the middle value or a value which lies in between the two values, which is nothing but the internal rate of return, which will equate the cash inflows, present value of cash inflows of the project with the present value of cash outflows of the project. Now let's try 40%. You pick up the PV factors at 40% from PVIF table. You present them here. Now you multiply the cash inflows with respect to PVIF factor of the project at 40%. You come to know the present value of cash inflows of the project for these years, for all these 5 years. It comes to 7,31,760. Now we are ready for computation of the IRR. Why I say at 10% when we calculated the total present value of cash inflows, it came to 12,32,520. Now at 40%, when we calculated the present value of cash inflows, it has come to 7,31,760. Therefore, one value is higher than 8 lakhs and other value is lesser than 8 lakhs. So we are ready for computation of IRR. Now, if you subtract the investment on the project 8 lakh rupees from total present value of cash inflows at 40%, which comes to 7,31,760, you get the minus or negative NPV of 68,240. Now, let's go for the computation of IRR. What is the formula for calculating IRR? Lower rate among the two, 10% and 40%, which is lower rate 10%, plus positive NPV, the positive NPV at 10%, the rate which you have written here. It is 4,32,520, that is what NPV we calculated, divided by difference in the present value of cash inflows at the two different rates. At 10%, it came to 12,32,520 minus at 40%, it came to 7,31,760 into the difference between the two percentages we tried or two rates we tried. 40% minus 10%. You don't have to look at the symbols and all. You only look at the difference between the two rates. It comes to 30. Fine. Now if you simplify this calculation, you get, and be careful with what I have done, you keep a bracket for this calculation separately, and outside of that you put percentage symbol. This is an easy way to do this IRR calculation. Do it very carefully. Now if you simplify, you get 25.91. Obviously the entire, the figure what you get out of this calculation is in terms of percentage. So 25.91% is the result of the second calculation. You add it with the 10%. So finally you get 35.91% as IRR for this project. IRR is greater than the cost of capital of 10%. Therefore, the project may be accepted. For any project, if the internal rate of return is higher than the discount factor which is mentioned in the problem, definitely the project is recommended for acceptance. I hope I have done my lecture very clearly. I recommend you to watch this video for a couple of times. It is worth watching for a couple of times so that you will find similar problems as easy ones when they are asked in the examination. Thanks for watching this video. I'll meet you in another video. Bye for now, everyone.